Hey there, I was asked to put together an explainer video for you so that you would understand where and how life insurance, premium finance life insurance, may fit into your overall estate planning design. Archimedes said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." And so our discussion today is going to be about the power of leverage inside of premium finance before I get to your numbers. So why is premium finance, why is the different arbitrages attractive to some potential high net worth individuals when it comes to financing premiums for life insurance? And number one, the wealthy can often earn more on their assets than the cost of borrowing the money from the bank. So currently today, we're borrowing money from the bank through some of our banking relationships. We're borrowing money from the bank at 5.5% to 6%. In order to pay a premium payment, unless you have the money already sitting in cash at the bank, and if you do, that's fine. This could be, we don't have to do premium financing. But if you already have the money sitting in cash at the bank, then it might make sense to make the premium payment. However, if you do not have it, but it's that all of your money or the most of your liquidity is invested in businesses, stocks, bonds, mutual funds, most likely you are earning much higher than a 6% return on those dollars. So wealthy clients have figured out it doesn't make sense to divest high earning investments to then buy a life insurance premium or pay the life insurance premium when they can leave that money invested, earn a higher rate of return, but borrow money from a bank lender at a lower rate of return, right? So that's arbitrage number one. The second arbitrage, which often this is the one that gets the most focus, but is arguably not the most important arbitrage, is that when the money gets into a properly structured policy, if we use an indexed universal life policy, the crediting methodology that's tied to the S&P 500, the NASDAQ, or some other index has a 0% floor and has upside potential. And oftentimes over the averages or over the long term, that interest crediting will outpace the cost of borrowing the money from the bank over time. Not instantly, not in year one, not in year two, but over 7, 8, 9, 10, 11 years, over a long term, you're going to get a higher interest crediting from a properly structured, reputable indexed universal life policy from a reputable company compared to borrowing the money from the bank, right? The third arbitrage is that when, specifically in the United States, when a premium is paid, it's paid with after-tax dollars. In other words, money has to be earned. Long-term capital gains, short-term capital gains, ordinary income tax has to be paid on those dollars, and then the premium gets paid. Now, all of that is not necessarily sequential happening at the same time, but when you make a premium payment, it's with after-tax dollars. And so when you borrow the money from the bank, those are not subject to income taxes. The banks in the United States don't tax you on loans. The Internal Revenue Service doesn't tax you on loans received. So when you borrow the premiums, you're not having to then use after-tax dollars to fund it. So clients have kind of figured out, wealthy clients have figured out, not only do I not have to divest my assets on higher earning dollars, not only is there going to be interest growth above and beyond the cost of borrowing the money from the bank, but I also don't have to subject those dollars to income taxes or capital gains taxes to also pay the premiums if we borrow them from the bank. And then the fourth arbitrage is that the death benefit that's in place is always going to be in excess of the loan. When properly structured, the gross death benefit is going to be higher than the outstanding loan balance. So you're going to have a net death benefit to your beneficiaries. And so that's the power of leverage in premium finance. Borrow at lower rates, maximize liquidity, and achieve financial efficiency. And so here's kind of what your numbers would look like. And by the way, this is kind of what the flow chart of it would look like. We would set up an entity. You would be the grantor behind the entity, but we set up an entity. That entity then owns the policies. That entity then takes out the loan. That entity is the one in place, the owner of the life insurance policy, and most likely the beneficiary. And so we'll walk you through all of that when the time comes and it makes sense. But here's kind of what the overall structure, and this is the explanation that I think they wanted me to provide for you. So columns 3, 4, 5, 6, 7, we have what we call life insurance details. So for a person your age, female, preferred, non-smoker, $20 million death benefit, right? Starting at a $20 million death benefit. To fund that policy, some efficient level, this particular carrier is saying they need $1,033,000 a year for 10 years, every year for 10 years for maximum efficient funding. And really what's happening is because you're so young, they're running cost of insurance and mortality out to age 100, and they're allowing you to condense all of those payments that would be for age 120, really. So for all of those years, let's see, how many years to age 120? 72 years takes it to age 108. So another 12 years would be 84 years. So for 84 years to your age 120, they're allowing you to condense all of the cost of insurance that would be needed to keep that policy in force inside of 10 years. And that's where the $1 million and 33,000 comes into play. When the premium is paid, because we are overfunding the cost of insurance, we're putting more in than what is required for a $20 million policy in year one, you have excess cash value. That excess cash value goes into the policy value. And that policy value is what I mentioned earlier, has the ability to earn between 0 or 1% on a minimum guaranteed basis up to an upside, depending on the interest crediting, of 12, 13, 14, 15% in some years, maybe even higher. Some years lower, but mostly higher. So from $1,033,000 going in, policy value, assuming we got the 6.82% crediting in year one, the policy at the end of year one would be $941,000. The difference between the $1,033,000 and the $941,000, that's the cost of insurance, policy charges, fees, and expenses being reduced. And then there's also a column called the cash surrender value. The cash surrender value is the portion of the policy that can be liquidated inside of 30 days and how much the cash value of that surrender would be worth. And in the early years, the insurance company charges, if a surrender were to take place, they charge a substantial fee for getting out of the policy too early. Typically inside of 7 to 10 years, they really charge a substantial fee. As we get closer to 10 years and beyond, you can see that it starts to equalize between the policy value and the cash surrender value. But in the early years, there is a hefty penalty for surrendering early, which is why we wouldn't want anyone to do this early. That being said, this column is what the lender of the premiums will use as their first position of collateral. We'll get back to that. And then you have the death benefit. And you can see the death benefit, while we're starting initially at $20 million in this design, death benefit at the end of year one is $20,941,000. This is what's called an increasing death benefit design initially, because it's the initial death benefit of $20 million plus the policy value added to it. So policy value at the end of year one would be $20,941,000. So we actually have a growing death benefit for quite a few years in this design. You can see for the first 15 years. Now, let's slide over to the loan details. Assuming you were not interested in paying the $1,033,000 out of pocket, which you could be, but assuming you're not, we would get a bank to finance those premiums on your behalf, assuming you qualify, which there's no doubt that you do. So we're going to borrow the premiums. We're also going to borrow the interest. So premiums plus the interest minus an out-of-pocket component from your standpoint, an out-of-pocket payment. And what we're doing is we're basically taking roughly 10% of the premium amount. We show you paying that out of pocket. So $134,000 a year out of pocket for 10 years. So again, borrowing $1,033,000, assuming the interest rate is 6% today, which is slightly lower than that, but let's say 6%, going down to 5.5% and holding steady at 5% going forward. And that's not to suggest we think that interest rates will be at 5% from a cost of borrowing from the bank, but we don't also think that the crediting is going to stay static at 6.82%. So this is showing an arbitrage, one of the arbitrages that I mentioned, of 1.8%, the difference between the cost of borrowing and the difference between the crediting, the hypothetical crediting and the policy. But from a math problem, how it works, premium borrowed plus interest borrowed minus out-of-pocket payment gives you your end of the year loan balance. And in year one, your end of the year loan balance is $961,000. Now remember, banks want interest, which they're providing you, they're deferring it, but you're also making a payment, and they want collateral. So if the outstanding loan balance is $961,000, and as I told you before, the portion of the policy that the bank can take as collateral in year one is $359,000. $359,000 from 961 is a $600,000 collateral gap or a shortfall. The lender needs to know where that $601,000 is going to come from in order to cure, in order to completely backstop the outstanding loan balance. And so that's where they're going to want cash, cash equivalents, brokerage accounts, marketable securities, or letters of credit. So they can have that collateral plus the cash value, and they're fully collateralized for 365 days a year. And that's what's the good part about this is you're doing this 12 months in advance looking forward. So every year before the anniversary date, we're going to see what's the new interest rate. So we want interest rates to go down in the United States. And we're going to see what's the policy crediting. We want the stock market to do well. We want that to go up. And every year there's going to be a recalculation to determine how much of this payment of 134 do you want to continue to make? Do you want to do more? Do you want to do less? Do you want to keep it at 134? And as a result, what's that new gap collateral calculation? And we do that every year. So what we want to make sure is that your collateral capacity is in line with this. And again, this is not a guarantee on how this is going to perform. This is an illustration based on assumptions. It could perform a little bit better. It could perform a little bit worse. So we want to make sure you, from a liability standpoint, to be conservative, that you have sufficient collateral above what we're talking about here. We don't want to get you to a point where you're close to tapping out on your collateral, but I don't think we are. And then column 15 here. Column 15 is the portion of the proceeds that your family would receive if you were to pass away in any one of those years. What we have happening in year 15 is we have the loan being paid off, right? So the loan is accrued. And by the way, some of our lenders were able to do this at no personal guarantee, non-recourse to you. So your only exposure is just the collateral that you have the pledge. But in year 15, we show the loan being taken out or exited from the bank. And we're going to take that from the life insurance policy cash value itself. So we're just going to move it from the left pocket at the bank to the right pocket at the insurance company. And we're going to take the bank out of the equation. And in doing so, your death benefit, your net death benefit hardly gets impacted. In fact, remember, we started at a $20 million death benefit, and the actual net death benefit is growing. By your age 71, it's at $32 million in this example. And so when we look at this and we look at your life expectancy, and your life expectancy is probably well into the 80s, maybe early 90s even, but we look at the out-of-pocket amount that you've paid. And in this example, $134,000 a year for 10 years. And then we look at the death benefit that's going to be received by your beneficiaries, and that's called an IRR, internal rate of return calculation. And in your 70s, the internal rate of return is 10% plus. And that's after-tax equivalent of probably 13 or 14%. And then we've got internal rate of return also into your 80s of 8 or 9%, which is an after-tax or a pre-tax, equivalent return of probably 12 or 13%. So where can you put your money to get the same tax treatment, to get that amount of tax-free distributions for your beneficiaries? And this is why premium finance, when properly done, can make a lot of sense. And just real quick to go back over, Arbitrage 1, you can make more on your money than borrowing the money from the bank. Arbitrage 2, we're going to potentially over time, over the average, earn more inside of the policy than the cost of borrowing. Arbitrage 3, the loans that are being made are on a income tax-free basis as opposed to earning the income, paying the tax to pay the premium. And Arbitrage 4, the death benefit is always going to be in excess of the outstanding loan balance. So I hope this was helpful for you to show you the power of leverage in premium finance. I think your design, we're off to a good starting point. Please let me know how I can help. Talk to you soon.